Hello everyone, welcome back to chapter 2 Money and Banking. Today we are studying one of the most fascinating concepts in economics, credit creation by commercial banks. Let me begin with a question. Imagine you deposit 10,000 rupees in your bank account today. Tomorrow your friend walks into the same bank and gets a loan of 8,000. Now here's the interesting part. Your still 10,000 is still visible in your account. Your friend also has 8,000 to spend. So the bank magically created money? At first, this seems impossible. Many students think banks simply store money in lockers. But that's not how modern banking works. Banks keep only a part of deposit at reserves and lend the remaining amount to borrowers. The loan is spent. The receiver deposits it again into another bank. That bank lends a part of it again. This process continues again and again. This is called credit creation. By the end of today's class, you will clearly understand how commercial banks create credit, why this process is possible, what conditions are necessary, and what limits this process. Don't worry if you have heard this topic is difficult. We'll understand it using a simple story, one flowchart and one numerical example. Now let's understand the meaning of credit creation. Many people believe banks only keep safe money, but banks also increase the availability of money in the economy through lending. Here's a simple example. Suppose Priya deposits 1 lakh in a commercial bank. The bank does not keep the entire amount idle. It keeps a small portion as reserves according to banking rules and lends the remaining amount to a borrower. Now imagine that borrower buys machinery from a shopkeeper. The shopkeeper deposits that money into another bank. That second bank also keeps a small reserve and lends the rest. This cycle continues. Notice something important. No new currency notes were printed by RBI during this entire process. Yet, more bank deposits have been created. This is why the process is called credit creation. Banks are not printing money. They are expanding the amount of bank deposits through lending. So use the phrase additional deposits in your definition. It's an important keyword used in NCERT and CBSE. Let's understand the process step by step with a real life example. Imagine Rahul deposits 10,000 rupees into a bank, that is bank A. Does the bank keep all 10,000 in its locker? No. The bank must keep only the required reserve. Let's assume the required reserve amount is 20%. 20% of 10,000 is 2,000. The remaining 8,000 can be given as a loan. Now imagine Anita takes 8,000 rupees as loan and buy a laptop. The laptop shop receives 8,000. What does the shop owner do? Instead of keeping the cash at home, the owner deposits into bank B. Now bank B has received a fresh deposit of 8,000 rupees. Again, it keeps 20% as reserve and lends the remaining 80%. This cycle continues from one bank to another. This is exactly how commercial banks create credit. Notice something important. The original deposit was only 10,000. But because the money kept getting deposited and relent, the banking system creates a much larger amount of deposits over time. That is the power of credit creation. Remember that bank lent only excess reserve, not the entire deposit. Now we are going to understand credit creation with numbers. Don't worry, it's much easier than it looks. Imagine Rahul deposits 10,000 in bank A. This is called initial deposit. Can the bank lend the entire 10,000? No. Every commercial bank has to keep a certain percentage as reserve. Let's assume the reserve ratio is 20%. So 20% of 10,000 is 2,000. So the bank can keep 2,000 rupees as reserves. How much is left? 8,000. This 8,000 is called excess reserve, and this is the amount of the bank that they can lend. Now imagine Priya needs money to buy a laptop. The bank gives a loan of 8,000. Priya buys a laptop from the shop. The shopkeeper now has 8,000 rupees. Does the shopkeeper keep all the money at home? Usually not. The shopkeeper deposits 8,000 into another bank. Now something interesting happens. Bank B treats this as new deposit. Again, it keeps 20% as reserve, which is 1,600. It can now lend 6,400. That 6,400 is spent, received by someone else, and deposited again. This cycle continues. Notice one thing important. The RBI printed only original currency. The additional bank deposits were created because banks kept lending and people kept depositing the money back into banks. This entire process is called credit creation. So never write the bank lent the entire deposit. They lend only excess reserve after keeping the required reserve. Let's see the complete process in one flowchart. This is the easiest way to remember credit creation. Bank A receives 10,000. It keeps 2,000 rupees as reserve and lends 8,000. That 8,000 reaches Bank B as a fresh deposit. Bank B keeps 1,600 and lends 6,400. That 6,400 reaches Bank C. Bank C keeps 1,280 and lends 5,120. Can you see a pattern? Every bank keeps a small reserve and lends the remaining amount. The loan amount becomes someone else's deposit. That deposit becomes another loan. This cycle continues until the remaining amount becomes very small. Now here's an important question. Each individual bank is creating credit only from deposits it receives. But when we look at the entire banking system, the total amount of deposits become much larger than the original deposit. That's why economists say commercial banks create credit. So in long answer question, always draw a simple flowchart. It makes your answer more attractive and easier to understand. Students usually find these two terms confusing, but after today's class you won't. Let's start with primary deposits. Imagine your father receives his monthly salary of 60,000 rupees. He deposits this amount into savings account. Did the bank create this money? No. Your father earned it from his job. The bank only accepted the deposit. This is called primary deposit because the money comes directly from the customer. Now let's see what happens next. The bank keeps the required reserve and lends the remaining amount to another person. Suppose the bank lends 48,000 to a shopkeeper. The shopkeeper uses the money to buy goods. The seller receives 48,000 and deposits into another bank. Now think carefully. Where did this 48,000 deposit come from? It exists because the bank first granted a loan. This new deposit is called derivative deposit because it is derived from the lending activity of the bank. So remember the sequence. Customer deposit money, that is primary deposit. Bank gives a loan. The loan is spent. The receiver deposits the amount into another bank. That becomes a derivative deposit. Here's a very simple analogy. Imagine planting a mango seed. The seed is the original source, that is your primary deposit. The tree grows and produces many more mangoes. Those mangoes are like derivative deposits. Without original seed, there would be no mangoes. Similarly, without primary deposit, bank cannot begin the process of credit creation. So always mention that derivative deposits are created through bank lending. This is the key word examiner look for. Now comes a very important question. Can bank create unlimited credit forever? The answer is no. Credit creation works only if certain conditions are satisfied. Let's understand each one. Assumption 1. Loan money returns to the bank. Suppose the bank gives Rahul a loan. Rahul buys furniture. The furniture shop owner receives the money. If the shop owner deposits that money into a bank, the process continues. But what if the shop owner keeps all the cash at home? Then the cycle stops. So the first assumption is the people deposit the loan amount back into the banking system. Assumption 2. Bank lends excess reserves. Bank cannot lend all the money they receive. They must first keep the required reserves. Only the excess reserves can be lent. This ensures that bank remain financially stable. Assumption 3. Reserve ratio remain constant. In our example, we assumed a reserve ratio of 20%. If the reserve ratio keeps changing every day, the amount available for lending also changes. To explain the basic process, we assume that reserve ratio always constant. Assumption 4. People prefer banking. Imagine everyone starts taking the cash at home. Will bank receive enough deposit? No. Without deposit, bank cannot create credit. So another assumption is that people continue using bank. Assumption number 5. There must be a demand for loan. Even if bank have plenty of money, they cannot create credit until people actually want to borrow. Businesses, students, home buyers and entrepreneurs must be willing to take the loan. Without borrowers, there is no lending. Now let's summarize. Credit creation is like a bicycle. The bicycle moves smoothly if all the parts work together. If one wheel stops, the bicycle cannot move. Similarly, if one of these assumptions fail, the process of credit creation slows down or even stops. So in a 5-mark question, explain each assumption with one line and one example. That makes your answer stand out. Now we have understood how commercial banks create credit. But here's the important question. Can bank continue creating credit forever? The answer is no. Let's understand why. First one, cash leakage. Suppose Rahul takes a loan of 50,000. Instead of depositing or spending it through bank, he keeps the cash at home. What happens? The money does not return to the banking system. The next bank does not receive a new deposit. As a result, the credit creation process slows down. Next is low demand for loans. Imagine businesses don't want to expand and families don't want to buy houses. Even if banks have money to lend, nobody is borrowing. Without borrowers, there is no credit creation. Third is RBI regulations. The Reserve Bank of India controls the banking system. It can increase reserve requirement or use monetary policy tools to influence how much banks can lend. So if the bank must keep the more money as reserve, they have less money available for loans. Number 4, banks maintain extra reserves. Sometimes banks voluntarily keep more reserves than the minimum requirement. This reduces the amount available for lending. Fifth one is economic slowdown. During uncertain economic conditions, both banks and borrowers must become cautious. Bank may reduce lending because of higher risk, while people may postpone borrowing. This naturally reduces credit creation. So remember the following idea. Credit creation depends on both bank willingness to lend and people's willingness to borrow. Let's connect credit creation to real life. Imagine Mr. Verma receives his monthly salary of 80,000. He deposits into his bank account. The bank keeps the required reserve and lends the remaining amount to a small manufacturing company. The company uses the loan to buy a new machine. The machine seller receives the payment and deposits into another bank account. That second bank now has a new deposit. It also keeps the required reserve and lends the remaining amount. Now another entrepreneur receives a loan. Can you see what's happening? One person's salary has helped another business expand. That business has generated income for another person. That person's deposit supports another loan. That is why economists say banks play an important role in economic growth. Credit creation is not just about banks. It's about helping businesses invest, create jobs, and increase production. Without this process, economic growth would be much slower. I think now you can tell me why credit creation is so important. Imagine there is no bank loan. Would many people be able to buy homes? Would students easily finance higher education? Would small businesses be able to expand? Probably not. Credit creation provides funds to those who need them. Businesses use loans to purchase machinery, expand factories, and hire workers. Students use education loan to build their future. Families use home loans to buy houses. All these activities increase production, employment, and income. When production and income increases, the economy grows. That's why credit creation is considered one of the key functions of commercial banks. However, remember that excessive lending without proper checks can also create financial problems. So bank must maintain a balance between supporting growth and managing risk. Let's discuss a few board exam tips. Many students lose marks because of small mistakes. First, don't write that commercial bank print money. Only RBI issues currency. Commercial bank create credit, not currency. Second, always mention that bank keeps the required reserve before lending. Third, whenever possible, draw a small flowchart. Even a simple diagram like deposit to reserve to loan to deposit make your answer much more effective. Finally, use keywords like primary deposit, derivative deposit, excess reserve, credit creation. Okay, so now you have completed one of the most important topic in money and banking chapter. Today we understood that commercial banks don't simply store money. They help increase credit in the economy. by lending a part of the deposit that they receive. We also learned the complete process of credit creation, the difference between primary and derivative deposits, the assumption required for credit creation, its limitations, and why it's important for economic growth. Before you leave, here's today's challenge. Why can't commercial bank lend 100% of the deposits they receive? Write your answer in the comments. Try to explain it in your words. If you enjoyed the lesson, don't forget to like the video, share it with your classmates, and subscribe to the channel. In the next video, we'll begin Part 6, Reserve Bank of India and its functions, where you learn why RBI is called Banker's Bank, the bank of issue and custodian of foreign exchange. Till then, keep studying. See you in the next class. Bye bye.